Welcome back, Jeff.
Hey, it's great to be back.
It's been a while.
Yeah, and a lot going on in the world right now.
100 days for the president. OPEC policy that has shifted significantly. Oil prices are in the 50s. I think last when we spoke, it was earlier in the year.
Yeah.
So it was a very different world that we lived in. So, I mean, we can start in any of those places, but I think let's start with the uncertainty that's in the market right now. A huge bit of it being caused by the demand or the trade wars and what that means for global oil demand, global growth generally.
Absolutely.
So let's start with that, because then it, of course, has massive implications of OPEC starting to unwind faster in a market that is so weak.
Right.
So, how do you see the world right now?
I think the downside is so large for all parties involved, whether if it is OPEC on the supply side or for the Trump administration on the demand side, they're all likely to pivot. It's just beginning with let's start with the trade wars. The financial markets have stabilized, but we have the physical markets. That's incoming. It's going to happen over the next 3 to 4 weeks. You look at port loadings into the west coast of the U.S. and then even come up the east coast. By the time you get to May 10th, that's it.
Yeah.
That's a month after the Liberation Day.
Yes.
And I think that's when you're going to feel the pain, and that's when you're going to start to see the inflationary pressures. Let's remember, Trump was not elected on creating jobs. He was elected on reducing inflation. That's his mandate. But
how are trade wars going to reduce inflation?
They can't, which means he's going to be in a difficult situation. And by the way, I saw a survey yesterday that showed 45% of Americans, only 45, know what a tariff is. They all believed that the Chinese were going to pay for this. So now they're getting that. And that's part of the reason why I think the administration flipped out when Amazon was going to publish the magnitude of the tariff next to the price.
Sense. Yeah.
But I think that's probably one of the core issues. And the one thing that nobody ever talks about is they go, oh, it's a tactical error by Trump. This is going to be the largest tax take of any president, I think, in the history of the United States, which means he's probably not going to collect it all. And also, it's a regressive tax. It's it's a VAT like we have here in Europe, essentially.
Yeah.
And it's going to hit the lower incomes. So we'll see, what is the probability, of a pivot. There's a couple ways. One is just unapologetically pivots, which is, the usual way that the administration has dealt with these situations. But the other one is we see the Congress, take back the emergency authority or overrule them. Actually, he probably would like option 2, then he can blame it on Congress.
Yeah.
But I think that as it really begins to see the physical bite there. Also, let's think about going the other way. Everybody's focused on the imports in the U.S., but let's focus on the exports coming out of the U.S. And when you look at the U.S. economy, it's a barbell economy. It's commodity production on one end and tech on the other. By the way, everything in between is what China has.
Yeah.
But the reality is, and I've said this over and over, you want to own the stuff in the ground or the stuff coming out of people's brains. That's it. So the Americans have the two best ends of the barbell. But the reality is when they export, they're exporting grains, gas, and oil. That's, actually I like to call it the 3 Bs.
Yeah.
Barrels, bushels, and bombs.
Yeah.
The bombs they're going to keep exporting the
Those
bombs.
ones, yeah.
But the bushels and the barrels, I think, are going to go through a lot of pain. And I think it's been 2 months since they've taken an LNG cargo. And so they're going to push back.
And ags as well, right?
Yeah.
It's completely kind of stalled buying that.
And the ethane goes into the plastics, which then gets shipped back to the U.S. So the U.S. will just pay its own tariff on top of China's tariffs. Also, if you were China, the elasticity of demand of what the U.S. imports from China is much steeper than the elasticity of demand of what the U.S. exports. And meaning that China can call up Lula at Brazil and go, hey, you got any beans today?
Yeah,
and they can send the
absolutely.
beans to him from Brazil. In contrast, a lot of those are specialized products coming from China. The Americans can't get away, so it just goes directly into the bottom line as a tax to the consumer.
And I think this is the thing, like we've seen China has just exempt ethane recently, and that's only because I think a lot of its own kind of crackers were just saying we can't get it from anywhere else. propane remains under tariffs, and we've seen a massive shift in trade flows as a result of that. And like you're saying, all that means is the finished products that's going to come back to the US in some form from some other country is just going to be that much more expensive.
Yep. Yeah.
So I don't see how, again, having said that, you've literally said it as well. They are already U-turning on a lot of these, right? We've dialed back a lot of the tariffs for some of the other countries. But don't you feel like the policy is, like, while you say they will U-turn on some of this, the policy is to decouple from China, though? Don't you feel like that's really set, like, come what may?
I love the line that Trump has all the wrong prescriptions for all the right problems. Right. You identify the right problem. Is this the right prescription in getting there? Probably not. Yeah. There's other ways to, have thought through this and done it, a little bit more strategically. But I think, it's going to hurt China. It's going to hurt the United States. We live here in Europe, and I am so bullish Europe. It's European exceptionalism. I mean, if they can't capitalize on this, God help them. And you look at, the equity market in the U.S. down 10%. Here it's up, 12, 13%. That's almost a 25% swing. That's trillions and trillions of dollars sitting over here. And then you look at the move in the euro. It's, something, I think it's 9, 10%. It's the biggest one we've seen since, I think it's 0203. And, I look at commodities usually sit at the center of, the big movements in capital flows globally. One occurred in 0203 when everything left .com and went to China. And it stayed there in China, and you and I's careers are made on that boom. Stayed there until 14 and 15. It left China in 14 and 15 and went back to Silicon Valley chasing Uber and Lyft, and it ended up being the Mag 7. Well, the Mag 7 party's over. Where does it go next? It's going to come here. And so I'm very bullish on Europe. And I think in terms of looking at the investment, it's going to be a Capex boom here that's going to rival anything data centers or the AI, because they're going to have to do manufacturing of defense. They're going to have to build infrastructure, technology, infrastructure. We can talk about Spain and Portugal, this year. And energy is going to be also at that center. And the Capex boom associated with it's going to be bigger than the BRICS. So I'm really excited about what's happening here, and I think it's going to be bullish commodities, oil, and the rest of them. And then you put that on top of what's happening on the supply side. What at least I've been a broken record on it. You've been better at maintaining it, but I'm a firm believer in the bull story on oil and commodities, and you see it in the U.S. rolling over. And one of the big flies in the ointment was the strength in the dollar. The dollar's gone. It's gonna weaken. I think we're going through a breather right here, and with the damage done to the dollar, it's not going to happen. And people go, yeah, Currie, where are you going to get the $10 trillion for the Europeans to go do this? They've got $2 trillion in U.S. treasuries and $8 trillion in U.S. equities. They take their $10 trillion out of the United States and bring it back here. That's where they'll get the money. That'll weaken the dollar, and that'll be really bullish for the overall commodity backdrop. And, China's going to stimulate off the back of it. But I'm not going to deny it's going to be a really painful next 3 months. And, because the physical markets are going to have to discipline the politics and the financial markets. And we're going to start seeing we saw round one of the, China, U.S. from a financial side. We're going to have round one of the physical one, and that one's probably going to hurt.
Yeah, and I like the way you phrase it, that the physical has to discipline the politicians, basically, right? Because until and unless they see it in the data and people are kicking and screaming, nothing's actually going to change. But the two things you mentioned, I think let's talk about the dollar first. Are you seeing signs of investors overall just saying the US is actually not as investable as we thought? Like, do you think the dollar now starts to weaken medium term?
They are deer caught in the headlights. They're not willing to go there. When I tell this bullish European exceptionalism story, they go, yeah, I hear you. And by the way,
but there's no conviction.
There's no, they go back to one point. They go, yeah, I've heard it for 30 years. They can't get themselves together. They can never be coordinated. And I go, there's two big differences today than at any other point in time in the last 30, I'm going to say 80 years, is security is no longer free and capital is no longer free. For the last 25 years, a quarter of a century, most of our adult lifetimes, Security was taken as given, and capital was plentiful. Those two things are gone.
No longer, yeah.
And if you think about, Germany was the biggest victim to that.
Yes.
They're
suffering the most.
And I was going to energy policy. We put this piece out called New Jewel Order a few months ago.
And read that.
And we basically made the comment, you cannot get the ordering of security over affordability over environment. And they put the environment above security and affordability. Why? Capital was free and security was free. That party is over with. And so, when we look at what disciplines and creates the best economic results, whether if it's in climate change or whatever, it's when you're scared. And, Europeans are probably pretty scared right now. The Americans are walking away. And, the Trump administration, it goes, hey, we're successful. We got Germany to come together and spend 1.1 trillion euros. Oil is at 50 something. Yeah. Interest rates are at 4%. And the dollar is weaker. They look at that as a victory. I think the rest of us, well, yeah, you got there on $50 oil killing off the U.S. shale patch. You got interest rates down to 4.1% by killing off global trade or weakening global demand. And you got the dollar down by weakening global trade.
Why talk about, don't let facts get in the way of a good story,
exactly.
Right? Yeah. And I've consistently said this, that we will get $50 oil under Trump, but not for the reasons that he's claimed, which was, we're going to surge production. It's going to be because demand's going to be dying, right?
Yep.
And the causality matters, like what's driving what. But on the second point, which was on shale, I've just spent about 3 weeks or so in the US, kind of over the last month and a bit, back and forth. I was even in Midland, literally with the operators, saw some of the operations. I don't think the administration, I shouldn't say administration, I think the energy ministry or the energy department understands it very, very well, but I'm not sure the White House understands. The biggest difference between Trump 1.0 and Trump 2.0 is the oil side of shale is just very different. Like what used to be, I would argue, the floor, or rather the ceiling of oil prices for shale back then is now the floor. Yep. Like people are talking about in the 60s, they're talking about dropping rigs, which is unheard of. In the 50s, even in the Permian, you might drop some, right? So that is the biggest challenge where everybody I was talking to in the Midland, which is at the heart of the Permian Basin, they're telling us it's getting so gassy. Like the whole acreage is getting gassier and gassier, which means, crude production, the peak is pretty much around the corner. Mm-hmm. And then just by not drilling, we're going to get some really steep declines. Yep. And I think the general disappointment in the industry for we're getting a lot of stuff done on the deregulation side, which is great, but the international policies are killing us.
Yep.
And I think that's the bit for me, yes, like you said, it's going to be very painful the next few months, but somehow I think the rebalancing this time around for oil will be a lot quicker. Yeah. Do you agree?
100%. And let's throw in Russia on top of that. I like to say 50% of the world's oil production comes from U.S., Saudi, and Russia. U.S. spends all their Capex on either a trade war or share buybacks or something, but not putting it in the ground. The Russians spend all their Capex on a war in Ukraine. And by the way, they're rolling over too.
Yes.
And Saudi spends all of their Capex on Vision 2030. They actually cut rigs yesterday.
Just a couple of days
ago. I look at it. So your three biggest producers in the world who drive all the growth are not spending. Then you get outside of that, Mexico and all those older places, they're rolling over. Yeah. Brazil's having problems. Guyana is the only one that actually you could say has a optimistic outlook. Guyana's not going to drive global demand. And let's go back to net zero 2050. Everybody believed that demand was going to roll over. By the way, and that piece that we put out on the New Jewel Order made the argument, peak oil started out being peak supply. Yes. It's going to roll over. And then peak oil became peak demand. And by the way, that's done. We're now on peak trade.
And I really like that argument. I think peak trade even more so now with the trade war.
Oh, yeah. But the peak demand, I think, so it's out. And, I use your numbers. You guys have no investment in refining after 2027. Yeah. And, the non-OPEC just falls off a cliff. Saudi's slashing rig counts. Prices are sitting at a point we're not investing. I know I sound like a broken record on the super cycle story. It's coming. It was a really, a lot of headwinds with the dollar, and we squeezed out every bout of supply we can get out of the system. So Iran is, at max, Venezuela's at max. You've got everything out there, and there's no investment. I just don't see how. Demand's going to power ahead because we've abandoned the net. I don't believe we were ever focused on it, but I think people didn't invest because they believed in
the
that
net zero.
peak demand. But the reality is, demand's going to keep going. You guys have 700 a day. We'll see what it ends up with after they pivot. I think.
If they pivot, then of course the number's going to be higher.
Yeah. And then let's say we go 1.1 million barrels per day of demand growth. There's no supply in 27 or beyond.
So I think for me it's more that this year is the pain, and next year onwards is the big kind of interesting thing, right? In some ways, maybe we needed this for the super cycle to play out because we were just stuck, in that like low 80s, and again, investment was neither here nor there. You almost get this downturn. It creates opportunities because if shale is rolling over already, and the 26 numbers again, if like. Right now, the damage to sentiment on the business side is just too much, right? But 26, if we get more clarity, the demand numbers are better, I think the market's just will start to look so different. Right. Also, because right here, right now, there's no inventory anywhere.
No, I mean, that's the thing about, the downside. I agree with you. The risks are to the downside right now, but that's everybody has that trade on. Yeah. Positioning's there. Everybody believes it. We all know there's a forward story out there. Does the market go, no inventory? Yeah, it could be bearish over the next 3 to 6 months or whatever. But I think what's going to happen is those ports are going to drop. Panic's going to sit. They're going to pivot. And let me remind, too, in fact, I was having this argument the other day in 2018 and 19. Remember when oil just collapsed in November and the equity market was coming off and it was all about tariffs, kind of like right now, people were scared. The hard data never showed anything moved over that time period. And the survey data, the other thing is all the survey data talking about the empire and everything like that reflects what people think is going to happen. The reality is when you go back to 18 or 19, you can't see anything in the hard data. That's easy to say now, but that period between November, it was Thanksgiving weekend of 2018 through about February it was the IP week of 2019, then it came back up. But it was pretty scary over that time period, but the reality is nothing happened.
I think the difference, though, this time we would argue is that the actual volume of tariffs he's actually put is the highest in a century. So I'd agree that ultimately it won't happen, but they have to walk some of it back.
Yeah, but I this is the argument I have, but if you go and you look at Los Angeles port data, it went down sharply over this week, but if you go 3 weeks out, it's back up.
Sure.
So why is it back up? Are the ships going to Vladivostok, pulling off the made in China thing, sewing in made in Russia, and then leaving? I mean, we know it happens in oil. Why aren't they doing that in
goods?
Yeah. Is there a lot of bluster here and a lot of chest pounding by the Chinese and in the Americans? But the reality is business as usual in the hard data. I don't know, but all I'm saying is everybody believes in the negative story. Sure. Everybody's bearish right now. If something tells me inside, fade that bearishness, because you're right. The story is very bullish on the backside.
Yeah, I think that's the interesting thing. I've never seen a curve which is this backward at the front.
Yes.
And then this much contango at the back, where it's like a Nike-shaped swoosh, right? Mm-hmm. Because everybody's saying there is a recession coming. Nobody knows when. Nobody knows the scale of it. But I've spoken to so many people who are like, we have to have some kind of short in our portfolio. So let's just short the back. Mm-hmm. And yet the front keeps rolling up because we don't seem to be able to build inventories, right? Yeah. So I do think the next few months, and I think it's a good time to talk about OPEC. If OPEC starts to unwind quickly, we will build a lot. We will pivot into contango. But that's where the demand does matter, right? If demand manages to hold up, different. If it doesn't, which is kind of what we're thinking, that we see the real kind of weakness from kind of Q2, Q3, then that's the pain point. But then we will rebalance kind of second half 26 onwards. Yeah. But then let's talk about OPEC now, because we've talked a lot about the demand side. Timing is not great, but then they have a different agenda. What's your read of the situation?
There's a lot of cross currents going in there, particularly with the Russian CPC I think one interesting factoid I picked up yesterday is the Iranians are trying to do crude swaps with the Russians and the Kazakhstan and the Caspian, which says they can't get this stuff out. Which is maybe you have a situation in Iran that's a lot worse than what we think.
Yeah, because right now the market's like talks are going well, there'll be a deal.
Yeah.
So that's also been the bullish Iran story is also being priced out.
Right.
Yeah.
Yeah, but the reality is, everybody's talking about we're at 100 days. There's still no deal in Ukraine, Russia. We've been talking about a deal in Iran forever, and the production is going out as much. But I tend to look at that. Yes, there has to be a shot across the bow by core OPEC to signal to the other OPEC plus members they need to get in line because they've been the biggest benefactors of the actions over the last 2.5 years. But beyond that, what is the effectiveness of really creating a price war and trying to punish everybody, particularly when, let's say, in Kazakhstan it's Chevron, or in the Permian it's Exxon, Chevron, it's big. There's the small little independents. They're decimated. They're already gone. I don't know who you're going to. And if you're waiting for the rollover of the shale patch, it's happening.
Yeah.
And
I don't get the sense that this has ever been a policy about the US, or non-OPEC.
Yeah.
It's very much like you say, it's compliance within the group.
Right. Exactly. Yeah. I see that, but I don't know. Let's go back to the three big oil producers: U.S., Saudi, and Russia. Can the three of them really withstand $40 oil for 3 months? I don't think any of them can withstand it. You look at right now. You look at Aramco. They lowered the dividend they paid the government from $31 billion. I think it's $19 billion right now, versus $7 billion of cash flow. That's a problem. Russia rolling over, U.S. not drilling. So again, 50% of the world's oil production can't handle it. So I don't think it's in anybody's interest to take it back further. But on the flip side, they have to send the signal. But is the signal going to be effective with the likes of Chevron? And I still go back to the one issue was after the hike last month, the next day the Russians go, oh, you can turn the Russian the CPC pipeline back on. What is that telling us? But I think the fact of the matter is you just can't get the oil out now. Right. And I think that, the ability to take this thing and, if the kingdom was in, super financial health and didn't have Vision 2030, the right answer is here, take it to $30 and create a lot of pain for everybody because they'll be the biggest benefactors on the back end. But I don't think the financial well-being of the kingdom or even the U.S., Trump will be calling up the kingdom going, hey, do something about this, because the likes of, the Harold Hams will be calling him. So I just think it's going to be very tenuous, the ability to take all of that 2 million barrels per day and put it on the market at a very rapid pace. I think
and we are hearing that I think there'll probably be some project cancellations. There has to be, right? Mm-hmm. You can't have it both ways. Cut some spending. But like you said, it'll be costly for everybody in different ways. I think the Saudis can probably sustain it longer than some of the other members if they were to cancel projects, etc. Mm-hmm. But at some point, at these price levels, if you're going to be in the 50s and let's say we go down a little bit further, there's going to be calls made. Yeah. And I mean, imagine Brent in the 50s. I mean, WTI is even in the mid to lower 50s. Yeah. I'm pretty sure the US producers are only kind of getting more and more worried by the second.
Yeah. I mean, people still come up to me, oh, yeah, let's go to the Middle East and go find some money. I'm going, guys, the money is right here in Europe right now. It's not in the Middle East. It's not in the United States. It's not in China. It's not. It's actually right here in Europe. And because I think, the pressure you're putting on places like the Middle East and by the way, U.S., Texas, all of it, it's not the same world we lived in a year ago.
So in terms of your preferred trades right now, because you are painting a picture, and it's quite refreshing to hear because, we've just been surrounded with conversations about just how bad things are, which they are. Yeah. But you are kind of taking a slightly longer term view and saying, actually, there are some opportunities here. So what would be your three picks? I can sense European something is on there.
I think if you look at the energy complex, power is trading 1.5 times, 1.5 times value. gas is fairly valued at 1%, but oil is trading 70% below its fair value. And I would say anything in the oil space is where you find the value.
But back end further out.
But even like if in the asset space, as well as on the market further out. And I think the upside going into the end of this year or next year, if you have the dollar start moving and we reprice, and a lot of it'll be how bad does it get. And when we look at German bonds, they've been trading like what a reserve currency should trade. They've been solid as a rock throughout all of this, while
the dollar has not been
all over the map.
Yeah.
And if you get to a point where people lose faith and you have a failed auction, my understanding is that what caused that pivot back thing was a failed auction. Well, it was going to be a failed auction,
absolutely.
But everybody goes, I'm not buying that until you do something.
And then they did.
They did it. So you're getting close to creating that unwind, and you get that unwind, and the dollar falls out of bed. That's going to be bullish the commodity space, very bullish the commodity space.
And any other asset classes, or generally?
Gold, I think, has probably ran its course.
Keeps going up, that one, yeah.
And I think, one, as they say, is one way to raise cash to create that sovereign wealth fund, sell the gold, and do something of that nature. That's why I'd be a little cautious on the gold side. But copper I really like. Oil and copper are the ones. I sound like a broken record, and copper worked for a little bit at the beginning of the year, but again, the inventories are low. The administration's made it very clear they're focused on the critical minerals. Our view on the energy transition is going to accelerate. And
you've said this right from the start. Remember, we did a podcast where you said under Democrats, usually oil production increases. Under Republicans is the other way around, and green increases. So exactly that. Yeah.
And you're going to need a lot of copper for it, and a lot of critical minerals. And the administration's made it very clear they want to go out and get this stuff.
Yeah. So you think energy transition accelerates?
Yeah, I think it's going to accelerate, but I think accelerate in the right ways. And I think what happened in we don't know what happened in Spain and Portugal yet. They've been very quiet about it. But, it clearly, actually, as somebody said, it's like trying to blame a car that has only an accelerator and no brakes. Because there's no brakes on the renewables. Yeah. You can't turn them off, and the wind blows too much and the sun's too bright. You're going to have a problem with overloading the system.
But that's why you need baseload, which is more stable.
Yep. Yeah. And we'll wait and see what the final verdict is. But I would tend to think which means you need to have investments in grid, investments in storage, batteries, chemical storage, and the rest of that. So, and all that requires metal, which is, and it's whether it's hyperscalers in the U.S., you need copper, you need metal, or grid. The U.S. needs grid. It goes back to my point. The investment outlook for the space is huge. And grid, battery, storage, all of that. I know one way I can say it is, what was the benefit of the net zero 2050 investment boom? It was getting the LCOEs down on renewables. That is a fact. They got it down, but it's so low now that it's immaterial. So what's material is the ROE. The only way, and this is why, because wasn't it great we can produce negative power? No, why? Nobody can use it. It's produced power when you need it, not when you produce it.
Exactly.
And I think the point here is you want to invest in things that are going to improve ROE. And I think that's just the natural extension. And we don't need in net zero 2050 to motivate people to chase ROE. Yeah. And that's why we call it the new jewel order. Just focus on the jewels, not on the green, not on the brown. Focus on getting delivered energy to a consumer, and you're going to make money in that space.
So, and then regionally, definitely Europe is your pick.
Absolutely. Yeah. I think finally, after years and years. And ultimately, this probably should have happened in the 90s, and then interest rates went to zero, and everybody forgot about it because the peace dividend was spent. It happened in the 90s, and then everybody forgot about it. U.S. kept doing. I like to make the point that. The U.S. Navy was the one that policed. Even the Russians and the Chinese were getting a free ride off the Americans policing Somali pilots or pirates and, going through the Red Sea. And it stopped last year when the Americans, should have gone in there and given a very stiff warning to the Houthis, and they didn't, which tells you they don't care anymore. It's your own.
It's your problem.
It's your problem. You deal with it. You pay for it. And I think that's why it's very different. And this area is going to have to do a catch up. And it's going to put security on top of affordability, on top of the environment, and do the right thing. But your point we made in that piece is by doing the right thing, putting security first, you end up with a cleaner outcome. You know, you look at like France, cleanest place in the world, and it didn't do it because it wanted to save the climate. It did it because it wanted to protect itself.
Yeah. And I think that's the thing. Maybe, you know, the fallout of all of these policies is that Europe actually does get its act together. And it does become a superpower, which it used to be, right, back in the day, and it's kind of lost kind of the path.
Finally, on that point of the superpower, the one thing I started thinking is everybody goes, they can't cooperate. Actually, just give it up. They're never going to cooperate, and use the Airbus model as the one. It's like a Lego kit.
Yeah.
And just different pieces, and just treat it as a big Lego, group. And I think we're going to end up with Fortress America, Fortress Europe, Fortress Russia, and Fortress China. And we'll probably end up trading with everyone, but the one out of those three that's the furthest behind is Europe. It's going to have to catch up because it free rided off the Americans for 80 years.
Yeah. So, final question: have you seen a sense or sensed a change amongst when you're going and talking to investors? Like, are they really worried about investing right now, or are they actually saying no? There's going to be some great opportunities.
They're worried. They haven't stopped, but their willingness to engage clearly has taken a back seat. But my response is it's not so bad out there. This
is also the time to do it, and once you get a correction,
and the one in 18 and 19 was much more painful. Oil went from 88 all the way down to 40, 50, something like that in the equity market. That was a lot more painful. This one may get more painful, but so far, it's relatively stable. And I don't think the tolerance for pain this time around is that high with anybody. So we'll see if it changes. But the answer to your question, yes, people are like deer. That's why I say they're deer caught in the headlights. They don't know where to go, but their inclination is go back to American exceptionalism. And that hasn't changed. They just think, oh, we'll wake up tomorrow, it's going back. I disagree. Toothpaste is out of the tube. You're not going back to American exceptionalism.
I think that's it. And that's the best note to end on, because I do think the world order is shifting. And I'm glad that we got to discuss it here.
Great.
So, thanks, Jeff. Thanks. Always good to have you.
Absolutely.
Come back soon. So there you go.
Great.
Thank you.